President Bostic, can you hear me? Are you there, sir?
I am here. Can you hear me?
I got you. Great. Great to hear you. It would be better to see you, but we'll take a rain check on that. I don't know if you heard, but I told Becky what my first question was going to be to you, which is given what's happened with the Atlanta Fed GDP now, given what's happened with the economic data we've seen, do you feel like the economy is accelerating here?
So I don't know if I would say accelerating. I think it's maintaining the strong momentum that it's had really for the second half of 2023. I think everyone has been expecting it to slow at a faster pace than it has. And so it might feel like there's some extra energy, but I'm not hearing from my contacts that things are getting faster or stronger, that demand is moving in the other direction. It's really just staying very strong where it was. And if there's any weakness or weakening, it's just at a very incremental level.
We were talking just a minute ago about this idea that we had thought that the economy, Fed Chair Powell said it several times going back to, 2022 in Jackson Hole, the economy needed to slow in order to bring inflation back down to target. That did not end up needing to be true in 2023. Do you feel like it's needed now? Does the economy need to slow to hit that 2% target?
Well, I think over the longer arc, the economy does need to slow to get to that longer run potential. At some point, there's going to be just too much energy in the economy, and you'll start to see upward pressure on prices. But right now, the supply has responded quite well, both in terms of supply chain and labor force. And there's evidence to suggest that the productivity is elevated as well. So as long as those things are in place, I think you can still get growth and see inflation continue to come down. Now, I will also say, though, in that environment, we should expect inflation to come down much slower than what many have expected. And that's one reason why I've really tried to pull back my expectations on when we'll need to move, because if that trajectory slows down in terms of inflation, then we're going to have to be more patient than I think many have expected.
Raphael, I really want to come back to this productivity story, but I do want to do a little nuts and bolts Fed business. You said you've pulled back when, but you've also pulled back how much? Are you still thinking just one rate cut this year?
Yeah, so I am, and I'll tell you, that's where I was probably 6 or 8 months ago. And then the strong performance of the economy at the end of 2023 caused me to think, well, maybe things are actually going to be moving in a way such that we can move sooner. I've actually gone back to where I was before because we've seen inflation kind of become much more bumpy in its trajectory. And it just says to me that we're just going to have to watch and wait and see how things evolve.
So if it's one cut, do you care to share with the audience here when you might think of doing that one cut? So
sure, I'm happy to do that. Look, if the economy evolves as I expect, and that's going to be seeing continued robustness in GDP, in employment, and a slow decline in inflation through the course of the year, I think it'll be appropriate for us to start moving down at the end of this year, the fourth quarter, and we'll just have to see whether the data come on. Like my outlook right now is that inflation is really just going to drop incrementally through the course of 2024, and that incremental progress will continue into 2025, and we won't get to our 2% target till sometime in early 2026. So with that outlook, I think that we have time to be patient, and we can just watch the economy and see if that's how things actually play out.
So you're confirming what I've suspected of you all along, which is I would not have wanted to be a student in one of your classes because the bar was so high for success. Some of your colleagues only want to see a couple more months of improved progress, but you want to see what amounts to what? Almost a half a year of better progress before you're willing to cut. Why are you more hawkish on this issue?
Well, you'll have to ask others why they feel where they are. But to me, I think there are two things going on here. So one, the road is going to be bumpy. And I think if you've looked over the last several months, inflation hasn't moved very much relative to where we were at the end of 2023. And if we continue on that pace, that's something we got to keep an eye on. But the second thing I would say is that there are some secondary measures in the inflation numbers that have got me a bit concerned that things may move even slower. If you look at the share of goods in the market basket for both the CPI, mainly the CPI we look at, but the PC as well, the percentage of those goods that have inflation that's growing up higher than 3% and higher than 5%, right. Those are much higher now than they were before. And they're starting to trend back to what we saw in the high inflation period. They're moving away from what we'd like to see. And so I got to make sure that those aren't hiding some extra upward pricing pressure before I'm going to want to move our policy rate.
Let me ask you the same question, though, but from the complete other side, which is unemployment below 4%, GDP running, at least for now, it appears, above trend, according to all the best forecasts that are out there. Why cut it all? It seems like the economy, does it seem to you as if the economy is doing just fine at the current rate, and the current rate may not be that restrictive?
Well, there's a lot of debate right now about how restrictive our rate is. But what I would say is this. I actually agree with you. An economy that's growing strong, that's creating a lot of jobs, that's putting Americans to work and getting them the salaries, those are good things. And I'm not in a rush to try to disrupt that dynamic as long as inflation is moving closer to our target. And so it's that dual picture, which really informs how I'm viewing what an appropriate policy path is. And it's one reason why I'm willing to be quite patient here. The one caveat would be that if employment starts to degrade, then I'll have to take that on board. But I'm not getting reports about that from anybody that I talk to outside of highly interest rate sectors like mortgages and realtors.
President, Professor Bostic, so good to talk to you this morning. I'll speak for my colleagues and say that we'll appreciate the next time you'll be around the table with Joe and Becky and Andrew and myself, and we'll have a longer conversation. In the meantime, thank you so much for your time.
Well, you're very welcome. And listen, given what just happened this morning, I need to become an engineer as well. And I'll happy to be in there, go in and see you in person. I'll look forward to that.